Kitco News, special coverage of the Vancouver Resource Investment Conference, is brought to you by First Mining Gold.
Hello, I'm Michelle Makori, and this is Kitco News, coming to you from the Vancouver Resources Investment Conference, where over 5,000 people have gathered, including some of the world's top macro economists, like the one and only Harry Dent. Harry, so good to have you with us.
Nice to be here, Michelle.
And as a recap, Harry is the founder of HS Dent Investment Management. He's also the president and founder of Dent Research. He is known as the contrarian's contrarian and is also a best-selling author. Harry, as the contrarian's contrarian, we want to have you back on the show because it looks like one of the predictions that you made last time that you were on Kitco could be shaping up to be very accurate. Last time we spoke was in January of this year, and you said that you expected 2022 to be the worst year ever for equities, that this is when the everything bubble was going to burst. You, unlike most people, put a timeline on things because most people shy away from that.
Dangerous thing to do.
A dangerous and a bold and brave thing to do, and you said that you expected a sell-off to begin in the second quarter of 2022, and into the first half of 2022, we will see a 40% drop in equities, that would be the first wave, but that ultimately you were predicting a 90% crash in equities. Is that an accurate summation of what you said last time?
It is. I'd say 86% is my target for equities, which is the biggest thing we've seen since 1929 and 32. And yes, first half of 2022. My target is this first crash. It's only the first crash of the bigger crash over a couple years. Will probably bottom around July, mid-July. So we're in that first crash.
So this first wave has begun now.
The first wave has begun. I think there's now not a big chance we'll see another slight new high. I think stocks are going down and you need to sell on weakness because this is not going to be another correction, okay? People are used to it, the last 30 years. Up, correction. No, this is the beginning of a long-term bear market.
Well, as we speak today, we have seen a bit of a bounce back. Yeah. People buying the dip. We have the S&P up a little bit today, the NASDAQ up a bit today. Even crypto markets are seeing a slight bounce.
Yeah.
You're saying that this is just the usual classic investor conditioning of buying the dip?
Yeah, they say that bear market rallies are the strongest rallies because when something finally peaks, people don't believe it at first. So it goes down and then people buy the dips because they've been taught to do that the whole downturn. So the rallies are strong, but at some point these rallies are going to be disappointing. I think this will be it. We've gone down, we'll have a rally here, and if we go down to new lows in the next month or so, which I expect them to say July, people are going to finally say, uh-oh, something's wrong. Something's wrong that we may have really seen a peak in stocks. And I'm saying January 4th and the S&P 500 was the peak, and major markets around the world have been peaking for a whole year from February 2021 to recently. So if a normal peak and correction, everything goes down. No, you don't see markets peak one after the next unless it's a long-term top.
So, Harry, what makes people get that shock factor that you're saying that is going to be different from the reactions that we've had since, I'm going to say, since 2008 here, really? What shakes things up? Well,
you have to get kicked hard. Because again, look at this. Since the early 80s, the market's only gone up. Yeah, we had big corrections in 87 and 2000, 2002 and 2008 and 9. And it keeps going up. People are now thinking it can only go up. You have to get shocked out of that. You know what the shock is? History shows it, a 40% crash within the first several months.
But what makes that 40% crash happen?
Something goes wrong and things are way overvalued. What people don't get, people think, the economy's strong. You know what? The economy's strong? Because the Federal Reserve's put like $5 trillion of money printing in the last few years and $5 trillion in the government in fiscal stimulus. It's all stimulus. The economy underlying from 2008 to now is weak. So the problem is that when things finally go down, it's going to be stronger than people think because the economy is so weak. Without this stimulus, we'd have nothing here.
All right, well, let's talk a little bit about the Fed. Because Jerome Powell promised me that inflation was transitory, okay? Turns out not
so much.
It is
transitory because the economy's going to go down.
Okay, so you do believe that inflation is going to lead to deflation, that when
Yes.
the Fed starts to tighten,
Inflation
we're going to have...
only leads to deflation in history. We had the strongest inflation in history in the 1970s. People forget that. You know what that was? Baby boomers, biggest generation, entering the workforce in massive numbers at great expense. Young people cost a lot of money to raise and incorporate in the workforce. Now, it's the opposite. We're going towards deflation, and what the Fed is doing here, they're fighting deflation, and they're going to lose that battle.
All right, well, let's break that down, because right now we have Jerome Powell saying that he is going to continue with an aggressive rate tightening schedule. He spoke today saying he is going to do whatever it takes to fight inflation, even if that means raising rates above what he says is neutral. So I'm assuming that's above 2%.
Above 2 or 3%. Yeah.
At the same time, we have calls of a recession increasing from all corners. Former Fed Chair Ben Bernanke saying expect stagflation. He's saying the Fed is acting a little too late, is behind the curve here.
No question about that one.
Bernanke saying that as the Fed tightens more, that increases the risk of a recession. The likes of former Goldman Sachs CEO Lloyd Blankfein also saying a recession is very, very likely. So do you see the Fed backpedaling on the rate hikes given this, or is fighting inflation still in the Fed's mind its top concern?
They are committed now, after overstimulating for so long, since 2009. They are now forced into tightening when the economy is a lot weaker than they think. They think, oh, the economy's okay. Well, they printed so much money. They've given people so much free money. It looks okay. As soon as this thing falls, it's going to be stronger than people expect. So I do not think the Fed is going to have four tightenings. I don't think they'll get that far before the economy goes down.
Is a recession inevitable?
Yes. I think the recession, my indicators, ECRI, my best leading indicator, says we're already on the verge of a recession now, not 6 months from now. We're about to go into recession already, and this is after $10 trillion, half of our GDP, of stimulus. How could you stimulate that much and go into a recession again? Why? The economy is the weakest it's ever been, as my indicator said 30 years ago.
But can we get a muted recession?
A soft
can we
landing?
get a soft landing?
No. There's no soft landing. I will say that. There's no soft landing here. The Fed is hoping for that. They don't understand the underlying trends of the economy. They just think if they do the right interest rates. No, there's no soft landing here. We are so overstretched. The biggest bubble in everything, real estate, financial assets, everything, even gold has been in a bubble. It's going to crash.
I want to get to the everything bubble, but let's just stick with the Fed here for a minute, because even if we have a recession, it doesn't necessarily mean a 90%, 86% to be more precise, equity crash. Can the Fed continue to kick the can down the road as it has been doing since
14
2009?
years.
Yeah, can it continue that?
The answer is no. 14
we've
years
come to the end
is
of the road.
longer than even I would have expected with all the stimulus in the world. You can't keep a dead body going, okay? I mean, really, it's just simple. The economy died in 2007, which I predicted 30 years before it happened. Baby boom, greatest boom in history. Growing up, spending money predictably at age 46, now 47, and then we would have a downturn from 2008 to 2023 until the millennials came along and drove us up. They are fighting this downturn when the fundamentals are weak. So they are assuming the economy is stronger than it is. The economy is only strong because of their stimulus.
So there's nothing the Fed can do.
Well, when they pull back on the stimulus, this economy is going to go down so fast they will not even see it.
The tapering is supposed to begin in June. What if they push out that deadline?
Helps a little. I think stocks already peaked on January 4th. And again, why there's been a succession of tops in major indices, including the US, the small caps and the NASDAQ around the world over the last year. That is only something that happens at a major long-term top. So I think the market's already topped January 4th for the S&P 500. And we're heading down, and the Federal Reserve's going to find out that their something for nothing stimulus didn't really work in the end, and people are going to find this out only when things crash. I'm telling you, you can find it out now.
Okay, so if the Fed backpedals a bit on tightening and doesn't continue with its tapering schedule, it's still can't
first of
rescue
all,
anything here.
They've waited, and everybody says too late. Even the Fed says too late. They can't, if they backpedal, it says they're scared the economy's weak. They cannot backpedal. Right. Now, they can be a little gingerly here, but that's a sign of weakness. So I think this is when they have stimulated things so far that there is no getting back to normal. They will live or die by this, and I think they're going to die by this.
So break down how this inflation becomes deflation. In what timeline? What can we expect?
Very quickly. Because, okay, I have an inflation indicator. It's workforce growth. You know what costs money to the economy? Young people. Anybody have kids? They cost and produce very little, okay? We had the greatest inflation in the 70s, not because of bad government policies or deficit, it's because the baby boom entering the workforce. Now we have the opposite. We have deflationary tendencies as baby boomers die faster than millennials rise in their spending. We've never seen a smaller generation follow a bigger one. We've never seen this before. So that's why they have to stimulate so hard, because the millennials, yes, they're going to start spending, yeah, but the baby boomers will continue to spend less until they die by 2042. I can put a number on anything you want to put. When people spend the most, die, anything.
Wait, so 2042, what's that?
That's when the last baby boomers will die on average. So the trends, even though people say, oh, Harry, the millennials are going to, the millennials are not anywhere near the size of the generation, the baby boomers. The baby boomers caused the greatest boom in history, which I called in the early to mid 80s, from 1983 to 2007, and ever since. Why have they been stimulating so hard and more and more and more? Because you're fighting a downtrend. The biggest generation in history is dying. Dyers are not spenders.
Well, but we do have, you could argue, Generation X
millennials
and Z. You got millennials,
yeah,
but
they're
then
smaller.
You've got X and Z.
I have the charts, okay? Those are a bump. Baby boomer is a 10-foot wave. If you're thinking like a surfer, these are 3-foot waves. A 3-foot wave cannot replace a 10-foot wave.
Well, you do use demographic models to predict markets.
That's my signature.
You were correct in the...
Economists don't study demographics.
You were correct when you predicted the Japanese stock market crash in early 90s.
People thought the Japanese could do no wrong. They were already done.
So because you've had a history of being correct on that front, our viewers want to know, what should they be doing now? If this is the everything bubble, where do you put your money? What do you do, Harry?
You just said it. It's the everything bubble, so you have to be out of everything. There's only two things to do well in a crash when everything goes down. Stocks, real estate, commodities, everything, including gold in the end. Treasury bonds. The safest long-term bonds, 30-year treasuries from the United States government, will be the safe haven. Is the U.S. government is the United States going to go into recession? Yeah, but we're the best house. We have way less money printing than Europe and way less more than Japan. We're the best house. Our bonds, 10, 30-year treasury bonds, will be the safe haven. Gold will not be. And I'm in a conference where everybody thinks gold's going to be the safe haven. Not. It wasn't in 2008. And treasury bonds did go up when everything went down in 2008.
Why is gold not the place to seek refuge in the storm?
Because it's a financial asset. It's the king, I would say, of the commodity sector. And it will do very well in the future when we get past this, because India is the biggest driving factor after China. India will be the next China. And Indians love gold. I've never been in a country where people love gold more than anything. Gold is an asset that has bubbled like everything else. All financial, remember I said all financial assets have bubbled. All will crash. Only the treasury bonds, the safest bonds, go up in that scenario, as happened in 2008. Gold went down. Only thing went up in 2008 was treasury bonds.
So give me your gold price line over the next, I guess, 5 years.
Yeah, well, okay. I would say in the next year or two, down to 900 to 1,000. And I'm telling you, that's going to look good compared to other commodities and stocks. Stock's going to be down 86%. And then I think gold in the next global boom, which will be dominated increasingly by Southeast Asia and India, and they love gold. I think gold could go to 3,000 to 5,000 in that boom, but not in the bust. It's people think Bitcoin's a safe haven. Bitcoin's the biggest bubble here. New industry. They think gold's a safe haven. No, gold is not the safe haven.
So when is gold going to 5,000? When do we come out of this?
In the next global boom from 2024 to about 2037.
So how do I-
And the next inflation commodity boom into 2038 to 2040. Gold will benefit from both of those trends.
So you see us coming out of this by 2024?
Yes.
Okay. So if we just have to ride out this ugly
crash,
storm.
the economy takes long, but yes. The worst of the crash should be by the end of 2023 if it continues to go forward and the governments don't.
And you see gold at 5,000 by 2024 or beginning its
I think
ascent.
gold could be 3,000 to 5,000 in the next global boom between 2037 when the millennials peak in spending and 2038 to 40 when the next commodity bubble. Gold is really the king of the commodity bubble. So I think gold could be 3,000 to 5,000 by 2037 to 2040.
2037, all right.
Yeah.
That's quite a wait.
If it does go down to 900 to 1,000, I think that'll be for gold buyers the buy opportunity of a lifetime. But what I'd rather buy? I'd rather buy global stocks, especially India. And
Global
Asia.
stocks in emerging markets is where
Emerging
you're putting
markets,
your money
yes.
during this crash.
That's the future. All developed countries have peaked now. We're the last in the US. Europe's already peaked in demographics. We're the last.
Now, last time we spoke, you said that Bitcoin does actually have a potentially bright long-term future, that you anticipated Bitcoin to come crashing down with all of the other assets, but ultimately you had a pretty good outlook for Bitcoin by 2037, I believe was the date you put out there. Explain that.
Okay, Bitcoin, here's the best definition I heard at a conference from another speaker, and I've stolen this line ever since. It's the digitization, cryptocurrencies are the digitization of all financial assets. Is that a big deal or not? So that's what it is.
Well, that's DeFi at large, perhaps. Is that DeFi or is that Bitcoin?
No, it's DeFi, but Bitcoin, I see, when it grows and gets more acceptance, could be the standard. That everybody's talking to this conference about gold coming back means that no, gold will never be the standard. It cannot keep up with the global economy. We're in a digital economy now, and Bitcoin could become the new standard for the digital economy in the future, replacing gold in that function. So I think Bitcoin, and I've tracked this versus the dot-coms. I compare the cryptos to the dot-coms in the late 90s. It wasn't just a bubble in tech stocks, it was the dot-coms, Amazon, okay? Amazon was a nothing burger and became the greatest retailer in history. So this is gonna crash, and I think Bitcoin could go down to 3,000 to 7,000 and then go to 500,000 to 1 million in the next global boom. So that will be the buy of a lifetime, but I wouldn't touch it with a 10-foot pole, even down 50%, 60% here.
All right, I want to break that down a little bit. So Bitcoin goes down to around 3,000.
3,000 to 7,000, yes.
In the next
2 years.
2 years.
In the global crash,
where
all
everything-
financial assets, and Bitcoin is a new financial asset. It's like the dot-com.
But ultimately, you see Bitcoin going to $500,000.
$500,000 to $1 million.
By 2037?
Yeah, and you know what? That would be enough for it to overtake gold as a global standard for money.
When you say global standard, do you see fiat currency being pegged to a Bitcoin standard? What do you mean by that?
It could be. I mean, you have to peg to something. I mean, here's the thing. This crash, after the greatest bubble in history, when everybody took off the shackles, is going to show that you can't just print money and grow, okay? And everybody's done it. U.S. is not the worst player here. Europe and Japan are worse. When this crashes, it's going to say, we need a new standard. We need something real, and we need something for the digital realm. Gold is not that. I think gold will grow to 3,000 to 5,000 in the next boom because Indians love gold. They like it as jewelry. Indians wear jewelry in places we can't even imagine.
Okay.
They wear more jewelry compared to their income than anybody I've met in the world.
So Indians love gold, but the globe is going to love Bitcoin long term.
Bitcoin is going to be the new digital standard, I think, for money. And that's the standard. So other things, crypto, are innovations in finance. But I think Bitcoin becomes the global standard. It's not there yet. It's not big enough. It's not widely accepted. And I think it'll crash the most. I think Bitcoin, like I said, 4,000 to 7,000 from 69. That'll crash more than stocks. That's what I would. If we have this crash I'm predicting in the next 2 years, the number one thing I'd buy would be Bitcoin or Ethereum coming out of it.
Number one thing you'd buy Bitcoin and
That's
Ethereum.
the next new wave, like the dot-coms, like Amazon were in the 2000-2002 crash.
Okay.
You know, Amazon went from 6 to 136 in 2 years and back to $6. That would have been the buy of your lifetime back in 2002.
Harry, the last time we spoke, when you made this forecast, we didn't have the factor of Russia's invasion of Ukraine. That has since happened, and not really according to Putin's plan. It's dragged on quite a lot longer than he expected. We've also got Finland and Sweden saying that they want to join NATO. Putin's latest comments have been that he's seemingly okay with that, provided that they don't get military strengthening from other NATO countries. We still don't really know how this entire conflict plays out. How does this fit into your forecast, other than being potentially a useful thing for the Fed to blame things on?
Yes, I see it as a trigger, okay? You know, when things are going up and up and up, people need to see something's going wrong to make them at least think twice about high valuations. We've never seen real estate this overvalued, way more, or stocks, even almost like 1929, but real estate is the most overvalued in history everywhere. You need something to say something's wrong to get people to think. So it's a trigger for this collapse. It will not be the cause of this collapse in financial assets.
But how do you see this conflict playing out? I mean, it's been useful.
I see
in terms of the Fed having something to blame.
Putin has the worst timing in history to do this. He's being aggressive at a time when the world not only does not want it, but the world can go into a downturn, and he could be blamed for triggering the downturn, even though it wasn't really him. So I think it's the death of Putin. I think Putin has bad timing here, and I really wish, instead of just, you know, advising financial advisors and investors, I wish I could advise governments, because these economic downturns would tell you to do things differently.
But do you see a diplomatic off-ramp for this conflict? How do you see this conflict resolving itself?
I see Putin got aggressive because he saw an opening.
Right.
And he wants to take over everything he can of the old Russian Empire, and he did it at the wrong time, and he's going to be punished for it. He's already being punished for it in public opinion globally. And when the economy goes down, they're going to blame it on him for triggering this downturn.
So, but do you see him just pulling his troops out of the Ukraine? Do you see him becoming potentially more aggressive and upping the ante?
No, actually, in the downturn, he might become more aggressive because the world's distracted by everything else. So, yeah, I think Ukraine's already kind of he keeps taking over his satellite nations around him. He's going to keep doing that. But I think it's going to go down as a bad move for him historically. He's not going to be looked like he was smart to do this.
Right, but is there a way for this to end in a somewhat, shall we say, peaceful resolution?
Only because the world goes into a global, mark my words, not recession, depression, like the early 30s, and everybody says, who cares about this? Okay. In other words, it's no longer a big issue.
Well, what about commodities? Because prior to our conversation, this didn't happen, and now we have been seeing a big rally in agricultural commodities, concerns of food shortages. How does that factor into the everything bubble? Because people are still going to need to eat.
Yeah, but commodities bubble more than anything. The difference between
but soft commodities.
Okay, difference between commodities and stocks. Commodities have already crashed, and then they're in a rebound. They go back down to new lows. The CRB, Commodity Resource Board Index, will go to new lows by my forecast, something like 100, but it will not go down as much as stocks, which are at new highs. Commodities are not at new highs. So commodities continue to go down just because the world slows and people spend less on everything, including basic stuff.
Okay. Well, Harry, ahead of this interview, I asked our viewers to send in some questions. And one of the top questions, and you've kind of touched on this already, was your outlook on the US housing market, which you said is also going to be part of this crash. So elaborate on that.
Well, number one, it's the biggest part of the crash. Most people don't own that much in financial assets like stocks, in their 401k plan. They own some. Everybody owns real estate in the United States. Everybody that can afford to does. So when real estate goes down...
Millennials don't. That's been part of the problem. They can't afford a home.
Well, they're the winners here. The millennials are going to kiss the ground when this happens, what I'm saying, because real estate will go back down to 2008 to 2012 levels, the lows we saw after the last crash. And remember, stocks crash quick. Real estate took years to hit a bottom, really mostly 2010 to 12. Real estate will go down at least to those levels and become affordable to the millennials for the first time in their lives. They're the winners. Guess who the losers are? People like me, baby boomers who've invested in real estate and keep saying you can't go wrong buying real estate, own real estate, and real estate goes down. Now, last time, 34%. Even the Great Depression, 26%. This is the biggest decline. This will be 40 to 50% real estate. We've never seen that before. That'll be a shock.
Is there any development or scenario that will make you reconsider your forecast?
No. What you have to, once you get a bubble, it has to deflate, and bubbles never deflate slowly. Everybody says we can have a soft landing. There is no soft landing anywhere in history to a major bubble, but it can be deferred a bit and then come down later. So I will not be happy and say people invest again until I see this bubble deflate. And I have my targets in stocks, in real estate, and I have all my targets. If we get to these targets in the next few years, I'll say you can invest for the long term again. Right now, if you are invested in financial assets, you are going to lose a lot of money, I think, in the next 2 years.
All right, so as we wrap up, I'm sure our viewers would like to know what your targets are for those particular assets.
Okay. I think the S&P 500 brought in is going to go down 86%. That's
right.
670. It's been up to almost like 4,800 at the top, okay? Real estate down 40 to 50%. Last time it was 34%. This is what hits people the most. When their home goes down in value and they're underwater in their own home and can't even borrow against their own equity. So that's my focus. And commodities go down even lower. And gold goes to about 900 to 1,000 in the crash and then zooms in the next book.
And when all of those low targets are met, that's when you're saying it's safe to jump back
Yes.
into the water.
Only when things get back to reality, which they are nowhere near. So everybody thinks, well, the Fed keeps doing this. No, we're in a bubble that's already so extended. There's nothing the Fed can do except extend this a little longer. The only way to get back to normal is to have a crash. There's no other way to get there.
Harry, how are you positioned right now then?
Treasury bonds.
Just Treasury bonds?
Just Treasury bonds. Now, normally, in good times, you diversify in, these risk assets, stocks, bonds, and real estate stuff. In this, there's only one thing, everything. Again, my statement is, without any qualification, this is the greatest financial asset bubble globally in all of history, and it has to come down, so all financial assets come down except the very safest, which is only the treasury bonds of the best governments, and especially bad house and a good house in a bad neighborhood, the U.S. treasury bonds, the only place I'd put money. Otherwise, and if you're too scared to do that, just be in cash. Just go to cash. Everything will come down and your cash will buy more of all financial assets. But I like the treasury bonds. They go up. In 2008, they went up.
All right, so cash or U.S. Treasury bonds is your best advice to ride out what is going to be the ugliest equity crash.
And if it doesn't happen by the end of 2023, then I'll shut up.
Okay.
That's the end of my bad cycles where it's most likely to happen.
Okay, so if this doesn't happen by 2023...
you will never hear from me again.
That'll be interesting. We like hearing from you, but at the same time, don't really necessarily want you to be right. But at least we're giving our viewers the tools to protect and prepare themselves for that scenario. But again, as I always say, Harry, I applaud you for putting your neck out there with specific timelines. Thank you for giving us your time here on Kitco News.
Okay, thank you.
All right, Harry Dent, appreciate it.
Kitco News, special coverage of the Vancouver Resource Investment Conference, is brought to you by First Mining Gold.